Hello, everybody. My name is Lexi Ling. I'm the Community Outreach Manager here at Consolidated Credit. So first of all, I just really wanted to thank you for Futurepreneur to co-host this session. I know usually when you have a session, it's probably going to be something business related, but today we're going to be talking about something that is more related to your personal finance. So before we do that, I just want to give you guys a quick intro of my organization and what we do. So we are Consolidated Credit. Similar to Futurepreneur, we are also a nonprofit organization. We're dedicated to helping Canadians achieve financial stability and manage their debt. And our goal is to provide guidance, resources, and support to empower individuals to take control of their finance so that they can live a better and more financial secure life. So I know throughout today's session, there's probably going to be questions that you have. So whenever you have a question, just leave it in the webinar chat. So I'll be monitoring them along the way. If it's something like really relevant to what I'm talking about, I may address it right away. But if it's not, then in the end part of today's session, we're going to have a Q&A session. I will try my best to answer all of the questions that you guys have, okay? So what are the topics that we're going to be discussing about today? Here we go. So here is a quick overview of what we're going to be exploring today, and more importantly, why these topics matter so much, even if you are growing a business. So we start by talking about money mindset, because financial success isn't just about numbers. It's also about your habits, your beliefs, and behaviors that shapes how you make decisions. So as young entrepreneurs, your mindset affects everything. So how you price your product, how you handle risk, or how you respond when things get stressful. Then we will talk about how much debt is too much. So many young entrepreneurs rely on credit cards, line of credit, or personal loans to get started, right? That's fine. That's completely normal. But knowing your limit help you avoid the point where the debt starts slowing your business down instead of supporting it. And then after that, we will walk through debt solutions. So from simple repayment strategies to all the way to legal options like consumer proposal or bankruptcy. So nobody start a business expecting to struggle, right? But life happens. So knowing your options ahead of time gives you power and confidence. And finally, we're also going to be covering about the credit report and credit score. So whether you are trying to lease equipment, get a business loan, or even rent a commercial space, right? Your personal credit is often the first thing lenders look at. So understand how credit works will help you open doors instead of hitting roadblocks. So everything we cover today is designed to help you build a strong financial foundation, not just for your personal life, but also for the future of your business. So when you understand this concept, you're better equipped to manage cash flow, make smarter decisions, and grow your business sustainably. Okay, so let's jump in. Let's start with something that doesn't always get talked about in the business circle, but matters just as much as your cash flow or credit, which is your money mindset. So your money, what the definition I already put it here, right? Your money mindset is basically the story you tell yourself about money. So it shapes how you save, how you spend, how you take on those risks, and even how you price your businesses or your services. So some of this come from childhood. So how your family talk about money, whether money felt stressful or secure, whether you were encouraged to dream big or play it safe. So some of it comes from your past financial experience, maybe your debt, maybe success, maybe fear. So how are these big pieces make your money mindset? So what it comes towards to what you believe you can do with your money, what do you believe you actually deserve financially, how you make decisions about spending and saving, how you think about debt and wealth, and how confident you feel when you deal with money. And the important thing is your money mindset doesn't just live in your personal life. As a young entrepreneur, it shows up everywhere. It affects how you negotiate, how you invest in your business, how you handle setbacks, and how you plan for growth. And when we talk about financial success, it's not just about having the right tools, it's also about having the right mindset behind these tools. So here, a couple of the reflection questions I wanted to ask you guys here. As I read through each of the statements, just think in for your own personal situation. Is it true or is it false? Okay. So first question. I feel intimidated by my money and how others handle theirs. True or false? Second, I tend to procrastinate with financial decisions or actions. True or false? Third, I only deserve what I currently have and nothing more. True or false? Next, I feel fearful and anxious about my finances. True or false? Next, I don't feel in control of my money. True or false? Next, I believe I'll never reach my financial goals. True or false? And last, money will never be my friend. True or false? So overall, if you think about, look at what do you answer mostly false or mostly true to those reflection questions? If you answer mostly false, congratulations, means you have a generally more positive money mindset. However, if you answer mostly true, there's some work that need to be done. So in the next slides here, I wanted to share that your money mindset is not fixed. You can definitely shift it. And when you do, your financial decisions will become clearer, less emotional, and more aligned with your long-term goals. So here I want to share with you guys 5 steps that can help you shift your money mindset. First thing first is always about understanding, right? Reflect on your past. Think about the money messages that you grew up with. Were you taught that money is stressful, limited, hard to talk about? So understanding your starting point helps you change the parts that no longer serve you. Second is to shift your perspective. So instead of saying something like, I am bad with money, trying to change it to a more positive perspective, saying, I am learning how to manage my money better. So this is called a financial affirmation. It might sound cheesy, but they help break years of negative conditioning. Third is about setting a clear financial goal. So entrepreneurs with clear goals makes more intentional decisions, whether it's reinvesting profit, paying down your debt, or saving for a big next step. So goals will give your money the direction. Fourth step is to track your money. So track expenses, not only expenses, but also your emotions. So for a month, try to look at where your money goes and how you feel when you spend that money. Do you spend when stressed? Do you avoid checking balance because it makes you anxious? So awareness always is the first step toward taking control. And last is just do the work and commit to changing your money habit. So building a positive money mindset is like building muscle. It takes repetition, so small consistent steps add up. And checking your accounts weekly, planning your purchase ahead of time, saving automatically, or reviewing your business expenses monthly. So a positive money mindset isn't about being overly optimistic. It is about being confident, informed, and intentional. And for a young entrepreneur, that mindset is one of the most powerful tools you can develop, because the way you think about money is gonna shape the future of your business. Okay, so now we've covered the money mindset part. Now let's talk about something that every young entrepreneur eventually has to face, which is the debt, right? Debt, I know when I talk about this word debt, many people just immediately connect it with it is something evil. So that isn't always bad. In fact, for many business owners, it can be a really useful tool for you to grow your business. But the key here is to knowing how much debt is healthy versus how much could start holding you back. So a simple way to check this is to calculate DTI ratio, which is debt to income ratio. So a DTI tells you what percentage of your monthly take-home income is going towards paying off your current debt. So let's look at a really specific example that I list out here. For example, if somebody's monthly debt payment, they have $325 for their car, $155 for their student loan, $200 for their personal loan. So in total, it's gonna be added up together to $680. And let's assume this person's monthly net income is your take-home income. So it's whatever amount you get after all the deductions. So it's $2,200. So this person's debt to income ratio is 680 divided by 220 and multiplied by 100%, which is 30.9%. So here's how you can interpret this number, because if you just calculate this number and you don't know how to use it or how to input it, then it makes no sense to you. If your DTI ratio is below 35, that means overall you're managing your debt well, and there's still room for you to save, invest, and handle unexpected expenses. But if your DTI is above 50, that means things can get tight quickly. You may start feeling financially stretched. It becomes harder to qualify for loans, and especially as a new entrepreneur, you don't want your DTI to be above 50. So keeping your DTI, debt to income ratio, low will give you flexibility, and the flexibility is what keeps small businesses alive during the slow month. During those slow months, unexpected costs or growth opportunities. Okay, so this is an important ratio. Next, I wanted to, so let's go a little bit deeper. Okay, so that becomes a problem. That never becomes a problem overnight, but through small warning signs that build up over time. And the earlier you can spot them, the easier they are to fix. So here are some of the biggest red flags that I want to share with you guys. So make sure to, when I explain along each of them, to check for yourself. Is any of those signs showing on you personally? So first one is to use more than 30% of your available credit. Even if you're paying on time, those huge usage can hurt your credit score. So this part I will explain more in detail when I talk about credit score. Second is that your minimum credit card payments are eating up to 10% or more of your monthly income. So that means your debt is growing faster than you can pay it down. Third is that you're relying on one credit card to pay another. So this is a sign that your cash flow is really tight. Next one is about you only making the minimum payment. So when you're actually, because I know sometimes when you get a credit card, if you don't know entirely how it works, it can really hurt how you are utilizing it. Because I used to work at TD Bank, and I know sometimes a client come into the bank with the credit card statement, right? And then they actually thought, because on the credit card statement, other than your balance, there's a place where it says minimum payment amount, right? And I don't know how many times some people actually do think that the minimum payment is the amount that they need to pay back every month, not the full balance. So if that's the case, you're not really reducing any of your balance. You're mostly just paying towards your interest. Okay, so this is a really important one. And then the next one is about choosing between expenses. So here, I don't mean like you're deciding whether to buy a new outfit or whether to buy the new latest iPhone, not like that. You're choosing between your key expenses like groceries, rent, phone bills, and debt payments. So that's financial stress showing up. And next one is that you max out your credit card or frequently close to the credit limit that you have. And last one is applying for new credit because you are trying to make ends meet. So if any of those signs sounds familiar to you, don't panic. It's okay. So these are the signs that it's time to rethink about your strategy. And one thing I always tell young entrepreneurs is that your business can only be as healthy as your own personal finance. So keep your debt under control, give you that breathing room to take more risks, invest in your ideas, and say yes to the new opportunities. Okay, so now that we cover about the warning signs of the debt, next is we're going to be talking about if, let's say, you are actually in the place of being in debt, so what are some of the options for you? So the first thing that I always recommend everyone to do is to try to DIY, do it yourself, see if it's something you can figure out on your own. If you're gonna try DIY, what are the steps? Step number one is to get organized. A lot of you have no idea how many people who are in serious debt and they don't even know like how much money they are owning in total. What is their interest rate for each of them? They have no clue. So first step is always to get organized. You need to make a list of all of your debt, including things like credit card, line of credit, student loan, car loan, so anything that you owe. And beside each of the debts, you need to write down the total amount that you owe, the minimum monthly payment, the interest rate. And once you see everything in one place, ask yourself, how much can I realistically put towards debt each month after covering my essential expenses? So this number will help you create a debt repayment plan that you can actually stick into. And step number 2 is to choose a repayment strategy. So here I want to share with you guys 2 options. So option number 1 is called the avalanche method. You don't need to remember that. What it means is just this method means paying off debt with the highest interest debt first. Why? Because the highest interest costs you more money over time. So this method will save you the most in the long run. So you still make the minimum payment on all of your other debts, but putting extra money towards the one with the highest interest one until it's gone, then move towards to the next highest. Okay, so option number 2, the definition, like the name for it, is called the snowball method. So this one is more about building that momentum. So you start by paying off the smallest debt first, regardless of the interest rate. So as you knock out each of the small balance, you feel more confident and motivated to keep going. So it's like getting quick wins to stay energized. So there's no right answer here. I say there's no right answer here. The best method is the one that keeps you motivated and on track. But I can only share that if it's me, I'm in the situation of in a lot of debts, I will always choose option number 1, because mathematically, number-wise, option number 1 is always gonna save you more money compared to option number 2. Okay, but if you're somebody who likes that momentum, you really wanted to see the amount of your debt decrease. Like for example, if you have 5, right? You have 5, 6 different kind of debt, and then you just wanted to reduce it to 4, to 3, to then you can choose option number 2. Okay, so after this, what are some other things that you can do here? Here are other ways that you can do to get ahead of the debt. First thing, actually a lot of people don't know about this, you can actually try, is to negotiate with your creditors. So many people don't realize it, but you can actually call your lenders and ask for help. I've recommend a lot of people do that, and then the success rate is more than you think. Because for example, you can call your lenders, you can request a lower interest rate, you can ask for a payment plan that fits with your budget. You can check with them, see if they will reduce your minimum payment or extend your deadlines, right? You'd be surprised how often creditors are willing to work with you, especially if you've been a reliable customer. Okay, I see along the way that people are giving me thumbs up or the hearts. Thank you guys for that. And then just wanted to mention one more time, if you guys have any question, welcome to leave it in the chat. I will address them. Thank you guys. Okay, second, another thing that you can try to do is to consider debt consolidation. So if you have multiple debts with high interest, a debt consolidation loan could help. So this means combine your debt into one new loan, and ideally with the lower interest rate. You will only have to make one monthly payment, which simplifies things and can reduce the amount you pay overall in interest. But just be careful. This only works if you avoid building new debts while paying off the consolidated loan. Okay? And what happens? Okay, what should you do after you pay off a debt? You might be wondering, should I close the account after I pay off a credit card? Personally, I will always recommend yes, especially if that card is there to tempt you to overspend, right? A lot of times when you go to any of those financial institutions, it might happen to you before. They say, oh, you have this pre-approved for this line of credit, even if you may not need it right now, but having a line of credit is working in your favor because the interest rate is a lot lower than a credit card, blah, blah, blah. So they have a lot of ways to convince you to open a line of credit with them, even though if you don't need it right now. But the thing is, once it's open, of course it's not going to charge you any interest if you don't spend on it. But that's how human mind or human brain works. Once you know something is available there, if you're tempted, right? Black Friday is coming. If you're tempted to buy stuff, then you cannot afford. You will feel like you can afford it because that amount of money is there available to you. And then you're thinking, okay, using this is better than a credit card because the interest rate is a lot lower. Even though the interest rate is a lot lower, I know, but still usually line of credit is anywhere between 10 to 15%, right? Depends on the offers they give you. Still, it's 10 to 15% interest. It's still high, right? So final thought here is just I want to share is that smart habits are the key. So at the end of the day, the real key to staying out of debt is to develop strong financial habits. I see one people have hands up. Do you want to ask your questions? You can leave your questions in the Q&A or in the chat if it's easier. Okay, so what are those good habits, good financial habits? You need to spend wisely. You only borrow what you can afford. You need to pay off your balance always on time. And you need to check in on your own finances regularly. And with consistency and the right strategy, you can take control of your debt and your financial future. Okay, so this is all I have to share about the ways that you can try to deal with that yourself. But I know it's not always possible, right? So from this slides onwards, I'm gonna share with you guys 3 debt solutions. It's debt management program, consumer proposal, and bankruptcy, right? The reason I arranged them in this order because the first one that I cover is gonna have less impact on your credit score or credit report. So the second one, third one, as I move on to each of them, is gonna have a bigger impact on your credit report. Okay, so let's us start with one of the most common solution, but most people actually don't know about this solution, which is called debt management program. And it's often called a DMP. So this isn't a loan. So this is not a consolidation loan, and you're not borrowing new money. It's simply a structured plan to help you repay what you already owe, and just in a more manageable way. And how it works, so usually you'll get a free consultation. So someone, for example, our credit counselor, right? They're gonna review your credit report, they're gonna look at all of your debt, and they will help you build a realistic budget. And then your unsecured debt, like your credit card, unsecured debt, let me give you a definition. So it means there's nothing attached to the debt. It cannot be a mortgage, because mortgage means a home is attached. It cannot be a car loan. It can only be things like credit cards, personal loans. So they're gonna get bundled together into one monthly payment. Instead of juggling 5 different bills, you're making just one. And the agency, like usually the credit counseling agency, they will negotiate with your creditors on your behalf to lower the interest rate. So for many people, I can say from our experience, right? For many people, the interest rate will drop from somewhere above 20% to anywhere between 0 to 5%. And that's where the real savings happens. And you make one monthly payment to the credit counseling agency, and then they will distribute the money to your creditors on your behalf. So each of the plan comes with pros and cons. What is pros about this debt management program? So first pro is that you keep all of your assets. So if you're starting your business equipment, your car, your home, everything. And second, it will protect your credit more than a consumer proposal or bankruptcy. Third is that it dramatically lowers the interest, which reduce stress and speed up the repayment. And last is that you get financial counseling, which helps you rebuild healthy habits. But what are the cons for this program? First thing is that you must repay the full amount of what you owe with just a lower interest rate, right? Second is that missing payments can actually remove you from the program. Third is that it doesn't reduce the principal balance, only the interest, right? So whatever amount that you borrow, let's say you borrow 5,000, your total debt is 5,000, you need to pay the full amount back, 5,000. It's just the interest that you're paying on that 5,000 get significantly reduced. So for many young entrepreneurs who still have steady income but feel overwhelmed by multiple payments, a DMP, debt management program, is a strong, low impact way to regain that control. Okay. Next one I wanted to talk about is called the consumer proposal, CP. It is a very common option here in Canada. So consumer proposal is a formal agreement with your creditors where you pay back less than what you originally owe. And it's a legal process, but it's not like bankruptcy. So here is how it works. So usually a licensed insolvency trustee will review your finances and calculate what you can realistically pay. They negotiate with your creditors to settle your debt for a reduced amount, and usually it's going to be somewhere between 30 to 70% less than the original amount, depends on your personal situation. Next is that you make fixed monthly payments for up to 5 years. I saw there's a couple questions about the debt management program, right? So what is the cost? I see this question about DMP. What is the cost of DMP, and do you take a percentage? Okay, so you need to, so I can only speak for our organization because I don't know all like the cost like in other organizations, but here at Consolidated Credit, so when you go through a debt management program, the initial phase that I mentioned about the consultation, it's gonna be free. But then later, let's say if this is a program you wanted to join, the cost of it is like there's an initial setup fee, which is $49. I think there is a percentage that we're charging because after all, we're still a business. We wanted to keep the business running, and then we wanted to help out more people who are in debt. But when you're talking with the financial counselors, you will know exactly how much is the monthly payment, and the percentage we're taking is it's already included in that monthly payment you're gonna pay. So you wouldn't pay like anything extra except that $49 of the initial setup fee. Okay, another really good question is negotiation. Like you negotiate with the creditors to lower the interest rate or extend the deadline, right? Do this negotiation affect your credit score? The answer is great. It's no, because it wouldn't affect your credit score. Things that I will explain, like what are the 5 factors that's gonna impacting your credit score, and then after that you will understand why this wouldn't impact your credit score. Okay. Another question is, what is the maximum amount of debt consolidation credit can take on when it comes to creating a consolidation solution for clients? I have clients that have about 138K worth of debt from various sources. Okay, so if it's that big amount, then definitely the DMP is not the way to go. So let me explain to you the other 2 options, consumer proposal and bankruptcy. But then the one thing I wanted to share with you guys is that even if, because our organization, we also work with a lot of other organizations who can help people with the consumer proposal or bankruptcy as well. So I will recommend you to recommend your clients maybe to give us a call, and then our counselor is going to assess their current situation and then make the recommendation on what is going to be best solution for them. Okay, really good questions. Thank you guys so much. I always like the sessions where people are really engaging and ask all of the questions. So kudos to you guys. So let's go back to the consumer proposal. I was talking about the steps that how a consumer proposal works, right? So the part, okay, I think I covered until, I don't remember. It's okay. Usually for consumer proposal, you make fixed monthly payment for up to 5 years. And once that 5 years is done, the rest of your debt is forgiven. During this time, creditors, they must stop calling, stop charging interest, and stop collections. So obviously the pros for this solution is obvious. So because you only repay a portion of your debts, not the full amount back. Second is that it gives you the legal protections from the creditors. Third is that there's no loss of the assets. So you keep your business tools, your cars, your home, etc. And last is that payments are fixed and predictable, which helps you a lot with the budgeting. But the cons here are obvious too. So first is that it impacts your credit for several years, but it's still less than the impact of the bankruptcy. Second is that you must be filed through a licensed insolvency trustee, and the cost of either consumer proposal and bankruptcy, of course, is going to be a lot higher compared to the debt management program. And next is that if your income goes up significantly, your payments may increase. So for entrepreneurs whose income has dropped or who are carrying more debt than they can realistically repay, a proposal can be a really smart way to, consumer proposal can be a really smart way to reset without starting from zero. Okay, so this is about the consumer proposal. Okay, another good question here. Does it make your credit go down when we use debt management program? Is there a minimum debt before you can apply? Okay, so I think I understand what your question is. Okay, I've already mentioned from this slide onwards all of the solutions. That solutions, except that when you are doing it yourself, it's not going to impact your credit score. Any of the solution that I share from this slide onwards, all of them is going to impact on your credit score. And then the only difference is that debt management program has less impact, then consumer proposal will have more impact, and then bankruptcy will have the worst impact. So that's the only difference. And then consumer debt management program, usually when you finish the full payment, it will stay on your credit report for 2 to 3 years afterwards. But for consumer proposal, that's 5 to 6 years. And then for bankruptcy, it's up to 7 years. And then another difference is debt management program. Once it's off the record, it's off for good. But then for consumer proposal and bankruptcy, it's gonna be public, which means even if it's off your credit report, later on in your life, if somebody would want to check if you have ever filed for consumer proposal or bankruptcy, there's places where they can check that. Okay, and is there a minimum debt before you can apply? Those like detailed questions, you can call to the financial counselors, and then they will walk through with you, see if, because I know probably the minimum will be around like 2,000, 3,000. That's the minimum kind of debt we can help with. But is there a range? Is there a range of the percentage? Oh, a percentage, you mean in the... Okay, so in the fee that we charge, that I mentioned, it's the $49 of initial setup fee, and then there's gonna be a percentage fee included in your monthly payments.
GMP.
In the debt management program. Yes. So for example, if let's say monthly you need to pay back $500, probably maybe somewhere around 5% of it, maybe it's a service fee to us, and then the rest is gonna be distributed to your creditors. That's the credit score. Let's now talk about one of the last resort, which is the bankruptcy. I hope none of us will need this service in your whole life, but let's still learn about that in case like one day it did happen or it happens to your friends, so you can give them advice. So bankruptcy, it is a legal process for situations where you truly cannot repay your debt. But don't think of this as a big failure, right? It's more like a safety net built into the Canadian financial system to help people restart. And here's what happens. So usually you may need to surrender certain assets, but many are protected under Canadian law. Most people keep basic necessities like personal belongings, tools of their trade up to a certain value. Your unsecured debt can get discharged, meaning you're no longer legally required to pay them. Your monthly payment depends on your income, family size, and whether you file for bankruptcy before or not. And a trustee will guide you the entire process and ensure that you know your responsibilities. Pros and cons for this bankruptcy program. Pros, it's obvious because it completely eliminates most of your unsecured debt that you owe. Second, it provides immediate relief from the creditor costs, wage garnishments, and lawsuits. Third is it offers a clean slate to rebuild your finance. The cons, of course. First, it has the strongest impact on your credit. Second is that you might require to surrender certain of your assets, depends on their values. So higher income individuals may have to pay surplus income contributions, and bankruptcy, usually it's definitely going to be a last resort. But for entrepreneurs facing severe financial hardship, it can offer you a fresh start needed to rebuild your businesses. Okay, so those are all the debt solutions. If you guys have more follow-up questions, welcome to leave them in the Q&A. And now we're gonna move to the last part of today's session, which is about credit report and credit score. It's just really important. Okay, so first I wanted to share with you guys where you can actually get your credit report. So here in Canada, we have two credit bureaus. One is Equifax, one is TransUnion. So on their official sites, you can definitely get your credit report. But the catch here is like usually for both of them, they only offer it like once or twice for free per year. If you want to check more, they're gonna start charging you. So this is why I share more of the free option here. So borrowwill.com or creditkarma.ca. So those are the other free options that you can use to check your credit report. Okay, I'm not sure like how many of you are actually aware of what kind of information is included in your credit report. So here that's addressed it. So a credit report, it is a detailed summary of your credit history, and it is prepared by a credit bureau. So what is the information of your credit that is included in there? First thing is, it is your personal information, things like your name, address, your social insurance number. So this part of the information is to make sure that the report is about you. And next, it will list out all of your credit accounts, things like credit cards, loans, or mortgages. So it shows lender that how much credit you have and how you're handling them. And third, it also tracks your payment history. So this part is crucial because it shows whether you've been paying on time or if you've missed any payments. So late payments can have a big impact on your credit score. And then there's also credit inquiries. So this happens when lenders check your credit before approving you for a loan or credit card. And too many inquiries can be a red flag. And lastly, it also includes your public records. Like if you have ever filed for bankruptcy or settled any debts, this can stick with you for years. So it's important to manage your credit carefully. So now that we know what is a credit report, how about credit score? So credit score, it's really easy to understand. It's a 3-digit number. It can be anywhere between 300 to 900. That represents your credit worthiness, and it is based on the information that is available on your credit report. So here are the 5 factors that's gonna affect your credit score. I'm pretty sure you guys wouldn't know all of them. So first one, everybody knows. First one is about the payment history. So this is the biggest factor, 35%. If you have been paying your bills on time, it helps with your score. But if you have missed any payments, it will hurt your score. Second one is the one that a lot of people actually are not aware of, which is called amount owed, or what I also call it credit utilization. So this looks at how much of your available credit you're using. So ideally, you want to use less than 30% of your available credit limit. Next one is the length of credit history. So overall, the longer you've had credit, the better it looks, especially if you've been managing it responsibly over time. And the fourth one is the new credit. New credit is the credit inquiries that I mentioned before. So it's every time that you apply for a new credit card or loan, it's going to be recorded as a hard inquiry. And too many of this can lower your score because it might seem like you're desperate for money. And last but not least, which is the type of credit. So having a mix of credit types, like a credit card and a car loan, can actually help your score because it shows that you can manage different type of credit. Okay, let me just give you guys a sense of what is actually a good score. So here in Canada, over 80% of Canadians have score above good, so meaning that they have score above 606, over 80% of them. But later on, let's say if you wanted to get a mortgage or get a car loan or get a business loan, if you can have your credit score under the excellent range, so anywhere between 760 to 900, it will be able for you to negotiate the best rates with the lenders. Okay, another really good question here about credit score. Does viewing your credit score affect it? No. So only when you check credit score, right? When people check credit score, there's 2 types of inquiries. One is called hard inquiry, one is called soft inquiry. When we ourselves, as the owner of the credit score or credit report, when we check our credit score or credit report, it's called a soft inquiry, and it wouldn't impact our score at all. And then to be honest, it wouldn't, even though it wouldn't impact it, like when you check a lot, right? When you check more frequently, you're more in control of your own credit. Indirectly, it may even help you to boost your score. And then when those lenders, so for example, when you go to a financial institution, you wanted to borrow more money, then when they check your credit score, or when they check your credit report, that's called a hard inquiry, and that's the ones that are gonna affect your credit score. Another good question, how long will hard inquiry stay on the report? So it's not like hard inquiry, they're gonna stay on the report forever, but they're not gonna impact your credit score forever. So usually when they check your credit report, right, your credit score is gonna be dropping a little bit, but right, slowly you can rebuild it back. So it's not like it's gonna be dropping and then you'll never be able to get it back. Next is that, how do we know what is the best interest rate? So that's the thing, we wouldn't. if then you have really strong bargaining power. The thing is, we don't. That's why if we do wanted to get a loan from anywhere, we compare, and then we can also check online, see. So usually, like, there's a Chinese app that I use, and then people always was discussing about, oh, what is the latest mortgage rate that you are able to get. So in this way, you get a more idea and you get a sense of what is a good rate, right? So here, next slide, I actually wanted to share with you guys how to actually build and maintain a good credit score. First thing first, it's always to pay your bills on time, because payment history, as we already saw in the last slide, this is one of the biggest factor affecting your score. And it's really important to make the full payments by the due date, whether it's for your credit card, your student loan, or your phone bill. But if in the situation where you are really struggling, then at least make sure to make the minimum payment. Next is to keep your balance low. So a good rule of thumb is to aim to use less than 30% of your available credit. So if you have a credit card with 1,000 limit, right, try to keep your balance under 300. So this shows lender that you're managing your credit well and you are not relying too heavily on it. And this one I can actually give you a real life example, because when my husband introduced me to his family, I made everybody check their credit score. So one of his younger sister, she's surprised when she checked her credit score, because she says she never missed any payment, but her credit score is only, I think, 620 something. She's surprised and frustrated. She doesn't know what's going on. And then when we check the credit report, we figure out it's because she's a student, so she only have a credit card with 1,000 balance. So that's all she got. But every month her balance is like 800, 900, or 1,000, sometimes even over 1,000. So this is why her credit score is low, because the credit utilization rate is really high. So after I told her that, she only did it for 2 months, and then she's able to get her credit score, I think, 100 up, so to 700 something. Okay, next point is about building a long credit history by keeping older accounts open and active. So even if you're not using them much, having those accounts have been open for a long time, works in your favor. Okay. Next is to avoid too many new credit applications, because each time when you apply for a new credit card or loan, it will show up on your report as a hard inquiry, which can slightly lower your score. And too many applications too quickly might signal that you're struggling financially. And last one is to monitor your credit report. I know a lot of you probably check your credit score, but not most of you probably don't check your credit report, but it's also really important. It's just so that, because identity theft nowadays, it's just so common. So you want to check it maybe once or twice a year. Make sure that there's no errors or signs of fraud, like accounts that you didn't open. So I already mentioned to you guys, you can use borrowwell.com or creditkarma.ca to check your credit report. And you don't need to write those down, because later on I will share the slides so that I will make sure all of you will have access to those resources. So this is all most content I wanted to share. And here I wanted to share with you guys really great, amazing tool that is available to all of you guys for free. So we partnered together with the Futurepreneur. So there's a platform called Coffee. Coffee stands for Knowledge of Financial Education. So for all of you, if you go visit futurepreneur.coffeetime.ca, let me actually show you guys what it looks like. So usually if it's your first time go to that site, you're gonna land it on this page. So you only need to click here, not a member yet, register now. You need to put in your your username, first name, last name, email address, and password in order to register account. After you click register, your email is gonna receive an activate email. After you click activate, it will guide you back to this page. Just use the credentials you just set to register in. You click login. So what is this platform about? Knowledge of Financial Education. It's a financial education platform. So what is available on this platform? So one of the things is that you will be able to speak to a financial coach, right? Let's say if you're somebody who never do budget, you want to go through a budget session with a coach, or you currently have some debts but you're not sure if it's something that you can manage by yourself, or you need to go through go to the financial counselor, you can also reach out to them. Or let's say you have you have trouble understanding why your credit score is low, you wanted to financial coach to give you some more tips of how to improve your credit score, you can also reach out to them. The platform itself, it have a lot of information here. It's mostly related to personal finance. First step here, you can see it's the financial basics. It covers topics like financial goals, budgeting, saving, and debt and credit. Under each of them, some of them may have workbooks, some of them may have a tool. For example, budgeting part have a budgeting tool available to you guys. And then in the learn how, there's just a bunch of more stuff for you guys to explore. So I really recommend for you guys to utilize these resources, because it's free for all of you to use. And personal finance is just something so important. Like a lot of times, if you don't spend time on it, you may feel like everything's fine. But once you spend some time on it, you will see there's places where you can make it better, right? So right now, this is all I have to share today. As we wrap up, I want you to visualize your financial journey like climbing a mountain. So you don't need to reach the top in one lap, but get there step by step with the right tool and the right mindset. Before I cover this, let me actually address some more questions. Does coffee on management? Okay, yes, coffee was only limited to the more fundamentals of the personal finance, like budgeting and managing debt and saving strategies, etc. I also cover things about retirement, purchasing your first home, those kind of things. Financial coach, they don't talk anything about investment advice or insurance. We don't cover much on in this sense, especially about investment, because we are not licensed to give out investment advice.
We have also another question: is it worth paying TransUnion per month to get a monthly report?
Yes, I was just about to answer this question. Really good question, but no, it's not worth it. So anything, I would say this, because for me, I'm really cost sensitive. Anything that I can get for free, I wouldn't pay money for it. Okay, so because those things, your credit report, it's available for you for free, right, on borrowwheel.com or creditkarma.ca. You don't need to pay them. So it doesn't make sense for you to spend money when you can get something for free. Okay, so really good question then. Okay, yeah, everybody likes free stuff. Okay, but another thing I worry about, because coffee is free, sometimes when things are free, people don't value it. But I just wanted to share with you guys, coffee is free for a reason, because we don't want to set any barriers for you guys to get access to the financial education that we think is really important. So it's free, but it's really valuable. So here are three steps that I wanted to share with you guys for today, to end today's session. Okay, so behavior wise, when should I start? And my answer is always going to be start now, not next month, not when things feel less busy, not when your business hits its next milestone. Every financial habit, good or bad, starts with a decision in this moment. So ask yourself, where am I today? Am I making decisions that move me forward or hold me back? Do I feel confident, or am I in crisis mode? So there's no judgment here, only awareness. And awareness is the first step towards change. And second one is the action-wise. Action-wise, think about what can I do now? So once you know where you stand, the next step is to take actions. Even small ones matters. So starting by, you can maybe build a simple budget, something that tells your money where to go instead of wondering where it went. You can build saving a little at a time. Even just $20, $5, $50 a week creates breathing room for your business. You can use tools and apps that makes managing your money easier. And of course, platform like Coffee exists to guide you with the coaching, learning modules, and more support. And if things ever feel overwhelming, you can talk to a financial coach or credit counselor. Reaching out for help, it's a sign of strength, not weakness. I know people don't like to talk about their finances. So that's why a lot of people, when they reach out to us, it's already too late, right? You don't want to be that person. You wanted to be ahead of your personal financial situation. And moving forward, is it working? Because progress doesn't happen by accident. It happens by checking in with yourself regularly. You need to review your budget, your debt levels, with your debt to income ratio and your savings. Set goals and break them down into smaller steps. Celebrate those little wins, even the small ones. Paying off a credit card, building an emergency fund, or maybe improve your credit score. So all of those actions will move you up the mountain. And the truth is, financial success isn't about being perfect. It's about being consistent, and every small step that you take today will build a financial foundation that will support your business tomorrow. And as you continue your entrepreneur journey, and remember, you don't have to climb this mountain alone. You have the tools, you have the resources, and you have the support, either from us or from Futurepreneur. But the most important thing now is to take that first step. Okay, this is all I have to share today. I will stay for a little bit longer. If you guys have more questions, now is the time to ask. Okay, so I see a question here. It says, can you please list the services that are free, which are paid? If you're asking about coffee, right? I'm not sure if you're asking about coffee, all the resources in here is for free for you guys. It's also include like the course to financial coach. It's all free. Only thing that it might cost you money is that if you are in a lot of debt and then they transfer you over to a financial counselor, and then if you join the debt management program, or like later on they refer you to consumer proposal or bankruptcy, only when you join those programs there's going to be a cost associated with it. But other than that, everything on this platform is going to be free. And then here, get help. You can either ask a coach, email us, you can make an appointment by choosing the time that you prefer us to call you, or you can call us directly. And then just a small tip here is that if you email us, usually I'm the one handling the emails. So if you have, or like I also can share my email address here. So this is my email address. If you guys do have anything like more personal, you don't feel like comfortable sharing here today in public, you can always reach out to me personally and then ask your questions. And I really appreciate you guys taking the time today, because you already take the first action, which is to register for today's session, and then you listen through the whole session, right? Now you need to think about what is the next actions that you guys will gonna take that is gonna make your personal finance better to the next and better level. Thank you all for joining today. Bye bye.